start off with, just in case any of you are either new to our webinars or haven't tuned in for a while, or is just curious about what today's conversation is. My name is Christina Cuprina. I am the Chief Economist at Sequoia Wealth Advisors, and we do a monthly webinar talking about the economy. And oftentimes kind of bringing it to our life and what's real, relevant, and important. Oftentimes economists can be blah, 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 talking about lots of facts, figures, data, and charts, all fine and dandy. Some people love that, but most people are like, what does this mean to me? How is this relevant to my life? Should I be concerned? Should I care? Is it non-issue? A lot going on in the world at any given time, so this is just one more thing. So the idea of these webinars that we've been doing for 4 or 5 years now is to kind of bring the economic story into a language and a way of talking and explaining that makes sense and is relevant to more people's lives. So what tends to happen in these webinars is many people register, and only so many can actually attend the events live due to the time of day and their schedules. So fortunately, people are great about sending questions in advance, which we'll be sure to answer today. Any of you listening though live, please do not hesitate. This is interactive. Post your questions, let us know the questions, send them over, and we will get them answered. With that being said, so how we're going to kind of do this flow today is Brian, who I'll introduce here in just a moment. He is a VP at Goldman Sachs, and he is been a speaker at our events in the past, both live and also on webinars and videos like this. And just a couple of months ago, Brian stopped by one of our events, our painting party, and was just chatting with some people, and people got really interested. So he came and kind of did a little mini presentation on the economy, and it was really popular. In fact, it was so popular, I eventually had to cut him short because the poor painting instructor that was running our event, she really needed to get us started. So I thought, well, Brian, if you can make it fit in your schedule, it'd be great if we could have you as a guest on one of our webinars so that you can talk to a wider audience, get their questions answered as well. And you all get to hear from me every month, so it's nice to have some different ideas, thoughts, and opinions on things. Brian is an excellent analysis and economist in the way he presents the material. Again, it's really valuable information, and he is one of the resources that we have at Sequoia. He and his firm are one of the excellent resources that we have at Sequoia to be able to do the work that we do for you as well. So today in this presentation, I will go dark for just a little bit and let Brian talk, and we're going to break a break every so often, and we're going to look for questions. If anybody has questions can be for me, questions can be for Brian, it could be for both of us. And then I'll go up and let him talk a bit, and then we'll go on as long as you are interested, but promise we won't go beyond the hour. And that being said, we'll also kind of break it in, and I'm going to talk about a few other things that have come up. There's been a lot of really interesting questions this time, a little bit different than some of the usual ones we get. And given everything going on in the world, great time to do it. So with that being said, again, please post your questions. We're going to do everything in our power to get them all answered today, in addition to the questions that have already come in. And without further ado, Brian Nash.
Well, Christina, thank you so much for having me join today with you and your clients. And you know, thanks to Sequoia Wealth across the board. You guys are an outstanding outfit, you know, based down in San Jose, but of course with multiple offices now that continues to grow. And you know, being able to be a partner with you and your clients over the last decade has been nothing short of a privilege. Doing in-person meetings, doing virtual, you know, any of these engagements, frankly, you know, as Christina and I prep, my goal is simply to give you Goldman's outlook. We don't pretend to have all the answers, you know, but we try to give a view on the economy, on the markets. And for you all, it's a little bit of a peek behind the curtain in how Christina and I interact. We'll catch up very regularly. Christina's always asking me questions around what are Goldman's thoughts on this and that. And, you know, Sequoia being fully independent, I know I'm one of, frankly, many voices that Christina and team are able to listen to help try to coalesce around how do you invest in what, you know, let's face it, markets always are challenging. Now, what the challenges are change every year, but there's always something interesting to discuss. And so, you know, as Christina said, over the course of today, I'll take around 10 or 15 minutes at the front end to walk through our economic perspectives. Maybe I'll check in there, Christina, to see if we have any questions. We'll get into market positioning and how we think from a portfolio standpoint, you know, you can find some opportunities that in this environment. And then also, we know we've got coming up in November the elections. And so before we wrap today, I want to give you our perspective on Washington, the elections, potential implications to consider. So that is an overview. Christina, if it's okay with you, I'm happy to go ahead and jump right in.
Give me one moment for the required regulatory disclosure.
Sure.
And I should also mention, we will be doing other presentations on the elections and the economy after the midterms. So it's great to get Goldman's view today, but as you know, as we get closer, more questions will arise. So we will be doing more talks on that with some expert Washington analysts as we have in the past. Regulatory disclosures, all the things that we discussed today, Brian and myself, about ideas, positioning, portfolios and whatnot, these are just ideas. They're just general information. They are by no means specific advice for any one individual. Each individual situation is different, and what positions or sectors that you should hold will depend very much on what is going to be the highest probability to get you where you are seeking to go. So what works well for one may not be best for another. Every investment has its own risks and potential rewards. So use this today as ideas for thought, and ideas hopefully will bring forth to me to talk about where this may fit in your portfolio. With that being said, I'm going to go off camera until question time so you can see Brian in all his glory.
All right. Well, again, thanks for everybody joining today. The title of our market presentation is Pressure Relief. Now, that can mean many different things as we think about the markets, but I've got two little kids at home, a 2-year-old and a 5-year-old, and I can tell you over the weekend, ironically, I was teaching my son about pressure. And where this came up, though, was, don't view me as a bad parent, please. We don't do this often, but as a special treat, we said he could have an 8-ounce can of soda over the weekend. And so he picked out his can of soda. He had it in the fridge. We agreed to have it after lunch on Saturday, and he went to open it and it fell out of the fridge. And then it rolled across the floor. But he was very excited to open that can. Well, my guess is everybody on the line knows what the risk is when a can of soda rolls across the floor. Pressure builds inside of that can. And so I took it as an opportunity to show my son that, hey, if you tap on the top of the can with your 2 fingers, you can release a lot of that pressure so the can doesn't explode and put soda all over the floor and all over him. And so, to me, that's a good example when we think about this current economic and market backdrop. What we find here today is we have a pressurized market. We have some pressures in the system, which aren't necessarily bad, but they certainly should be taking our attention as we think about how we want to invest and, frankly, what sound portfolio construction can look like around some of these pressures in the system. And so, I think when we think about investing, you want to have release valves within your portfolio construction. And I know Christina and Sequoia are very much out in front of this, but what do I mean by that? Well, look, it's really easy in markets like this to say, hey, let's own tech stocks. Let's go buy some more NVIDIA. What's harder to do is say, hey, let's go buy some fixed income or bonds that really haven't shown so much return today. Do you want to utilize things like alternatives in an environment like this? And so there's a lot of different resources and investments at your disposal through Sequoia that we can help solve or at least prepare you for some of these pressures in the system. Now, for those on the line, frankly, there's a lot of data out there, economic data, that can make you be a little bit pessimistic on this market. We think there's also data out there that can allow you to be optimistic. And so my goal today is to share Goldman's outlook, but know that we're very understanding that there's frankly a lot of different views that are being portrayed based on the market data and the economic backdrop we have today. Again, I mentioned it at the start. We don't have all the answers. A forecast is only as good as our latest forecast. But ultimately, I want to give you some of the reasons behind our view. And my goal is that you step away from this meeting feeling at least more comfortable in the inputs as to why Goldman Sachs still remains relatively optimistic on the forward path. So jumping into the presentation, let me get to full screen for everybody here. I understand some of the data points are smaller. Know that this deck is able to be shared by Sequoia with you following the meeting for anybody on the line that would like to take a closer look. But look, I think when we look at the traits of this economy, and I'm going to cover some of these bullet points down the left-hand side to start. I'd say where Goldman has been different than the street, different than consensus, is we see pretty robust US and global growth. We see better US growth than what consensus and the US Fed sees. We ultimately expect that as we move past peak fiscal policy, peak monetary policy, as we see inflation begin to move lower, as we believe moving forward, as monetary policy drag, i.e. higher interest rates, more than likely move sideways to lower, this should allow for growth to remain resilient in the US and global economies. When we look at equity markets, and this is going to bullet point 3 here, when we think about concentrated markets like we have, and you've probably heard the buzzwords, the Mag 7. These are companies like NVIDIA and Amazon and Microsoft and Alphabet that have really been the primary drivers of earnings growth in the US markets. There's a lot of market participants, frankly, for good reason, saying, hey, can this continue? Can these names continue to run? Or will they sell off? Or is there another path? Now, our general belief is rather than those big names selling off, we think you could see a bigger portion of the market start to participate in better returns, which would mean, hey, maybe there's another leg higher to this market rather than a big leg lower. So can we get more market participation beyond, call it the 7 to 10 names that have done the heavy lifting the last 18 months? We think so. Now, as it relates to interest rates, we do expect long rates, which we would measure by 10-year treasuries. We expect longer interest rates to remain more elevated versus fall. But at the short end of the curve that the Fed can impact, we would expect shorter rates to begin to move lower as lower inflation begins to print into the system. And to be fair, this has been pretty messy this year. At the start of the year, the market was saying inflation is going to materially move lower, and we're going to get 6 cuts by the Fed this year. You look at it today, we've had 0 cuts by the Fed. Inflation's been quite stubborn, more so than what the market's expected. And right now, the market is pricing in 1 rate cut for the year. So again, this is always a bit of a moving target. Nobody has a crystal ball, but inflation is proven to be a little bit stickier. We do think short interest rates will begin to fall later this year, but rates in general are probably going to remain higher for longer. Now, there are risks in this system beyond just valuation, beyond just inflation. Clearly, we have a US government debt pile that continues to grow and grow pretty substantially. You now have interest payments that are growing quite aggressively, going to surpass even our overall defense budget at some point in the near future. So clearly, US government debt is a growing issue. And, the threat of geopolitical escalation globally is clearly something in front of us with the challenges we face today. And so, there's no shortage of things for us to discuss. But I think what's really important for us is we do think there's enough economic growth to be supportive of these markets. And we do think that sound portfolio construction is going to really matter as we look forward the next 10 years. And this chart in the lower right, we think helps describe that. This is Goldman's 10-year forecast for major asset classes. So if you look at US equities, to put this into context, the last decade, we've gotten just shy of a 15% annualized return. We think over the next decade, equity returns in the US are going to be good, but they're going to be cut in half at around 7.5%. With that comes volatility or standard deviation of around 16. Now, we know the last couple of years, bonds have not been the safe haven that they normally have been viewed to be, right? We've had interest rates climbing. Bonds have been under pressure with negative returns. You look at the next decade on high quality fixed income, the returns are going to be less than equities, but with only 1/4 of the volatility, and the fact that you're now getting good coupon, good yields out of bonds, it's hard to see the value today when you look at the return, but looking out over a decade, this return to risk, in our view, is a really valuable component. And so there's different things in here as we look forward that are going to be important in portfolio construction, including things potentially like alternatives and cash. And obviously cash has been a great place to be over the last 18 to 24 months. Now, moving forward a little bit, some of the sources of risk in this market that we think are important to keep in your purview. Now, we've all heard of the inverted yield curve, and we've now been inverted for what, going on about a year and a half. Now, the concern last year was, hey, normally when you see an inverted yield curve, which is short interest rates, call it 1-year treasuries at a 5% yield, being higher than 10-year treasuries at around a 4.25% yield. That's what we mean by an inverted yield curve, where normally you get paid more for longer duration bonds. Right now, that's flipped. Well, historically, that's a good recession predictor. Goldman's outlook is that isn't as strong as a predictor as it was 20 and 30 years ago because our economy has changed. We're now a services-oriented economy and less of an industrial-led economy. So I think what's interesting for our team is, when does this curve uninvert? i.e., when does it normalize? When do short rates fall below long rates? Because historically speaking, when that uninversion happens, it's about 7 months from that point to when, on average, we go into a recession. So we haven't uninverted yet. We don't think the uninversion happens this year. But as we move into next year, if we see an uninversion, that is an interesting trigger point to say, hey, normally about 6 to 7 months from now, a recession is more likely. So one point to keep an eye on. I think another point of volatility is, right now we have an S&P 500 that's around 5,350. I don't know where it ended today. Goldman Sachs's year-end outlook is 5,200, and on average, consensus is at about 5,100. So we have an S&P current value that's above the year-end target. So why does that create volatility? Well, any earnings misses, any forward guidance from companies that becomes weaker, hey, any change in view from the Fed, let's say inflation becomes stickier and now there's no rate cuts priced in, all of that creates a little bit more challenging backdrop for the stock market. And so when you get to levels where the stock market is at or above projections, when you get bad news, you tend to feel it a little bit more. And so to be clear, we are not recommending for clients to exit equities. To be honest, like, look, coming into this year, clients thought equities were expensive. And you look at it year to date, equities are up 15%. We would argue this is a tougher market to be on the sidelines looking for an entry point to the stock market versus being invested in the stock market and making sure you have the right pressure releases or right risk management for your own risk tolerance and your own financial plan. Other risks, we now have 4 countries actively collaborating against Western interests. And so, does this grow? Does this shrink? There's clearly geopolitical tension globally that could create more friction for risk assets. And when you look at the Mag 7 right now, they're at a 31 forward multiple. That's the price on these stocks relative to forward earnings expectations. To put this into context, the multiple on the overall stock market is at about a 22 forward multiple. And over the last 20 years, the average multiple for the market is closer to 18. So we are above averages, but I would tell you from Goldman's view, the Mag 7 are not expensive because they have really good balance sheets. They have really good forward guidance on earnings. They have incredible amounts of cash on hand. You look back to, say, like the 2000 tech bubble, they're investing more than double of their overall revenues back into technology, back into the business, which technically or traditionally is a pretty good driver on forward growth for these types of businesses. So we're not telling people the Mag 7 are too expensive to own, but more just recognize that valuations in general are a little bit rich relative to history. Now, those are some of the sources of volatility. As we look at some of the sources of stability, the misery index, this measure it's a really simple measure, trying to just look at history, gauging how in pain is the individual consumer in the United States. And so what the misery index is a measure looking at the unemployment rate and the current inflation rate in this country. Now, we all recognize inflation feels high, but relative to the 80s, inflation is pretty low. You look at unemployment, sub 4%, that also is pretty low. And so right now, even though, I think consumers certainly are feeling inflationary pressures, only 22% of the time is the US consumer feeling better off than they are right now as it relates to unemployment and inflation. Household wealth is in the 98th percentile as a percentage of disposable income. So what does that mean? I think clearly there's a lot of concerns in the headlines around the consumer, around dwindling balance sheets, around things like credit card balances growing, delinquencies on mortgages, delinquencies on car payments. Now, we're not debating any of those stats, right? You do see delinquencies growing. You do see record credit card balances. But I think to put it into context, what our research group would say is, all right, delinquencies are growing, but off of what base? And the reality is 18 months ago, coming out of the pandemic, we had the lowest base for delinquencies in 50 years. So delinquencies growing makes sense coming off of the lowest base. When think about credit card balances at the highest level, this is a country predicated on leveraging debt to grow. And so frankly, if we're growing as an economy, we would expect credit card balances to grow. What we would look at, though, is not the credit card balance, but what is the ability for the consumer to pay down that debt? And so if you look at this chart in the lower left, this is looking at the debt serviceability of a U.S. consumer. What is the ability for a U.S. consumer to manage their debt? And what you can see here is at a 6.4% level, outside of coming out of the pandemic where there was a lot of money provided to consumers from the US government, this is the best consumer debt serviceability that we've seen in 25 years. And so to be clear, paying attention to the consumer is important. It's possible the consumer is the next cause of the recession if we see sales grow into the ground from the consumer over the next 12 to 18 months. All we're saying is right now, the data is not showing that. Another lens to look at is U.S. mortgages. So, going back to 2008, you had around 70% of mortgage holders in the U.S. on variable rate mortgages. And so when mortgage rates skyrocketed, that immediately put a ton of homeowners underwater. Today, you have the majority of homeowners are on fixed rate mortgages in the United States to the tune of 90% of mortgage holders are on fixed rates. And as you see right here, the majority of them have fixed rates under 3%. You put this into context next to the UK or Australia, where they look a lot like we did in 2008 with 70 to 80% of mortgages on variable rates. At least for US homeowners, they're in a much better place today, not being affected by the move higher in rates like we were in past market cycles. Now, I touched on this when I was last with Christina in person at the painting event. I just think this is really interesting. I'll try to cover it relatively quickly. A lot of economists were calling for a recession last year. We were not in that camp. And look, there was clear data that was showing, hey, you need to be worried about a recession. You really need to be. Some of that economic data that was showing a recession is what we would point out in this chart in green. And so you can see these green lines that are below the median are essentially pointing to negative prints. Now, when we show soft CAI, CAI stands for, CAI stands for current activity indicator. This is a way for us to measure the economic data points that the Fed uses. So soft CAI, that's really sentiment. That's feelings. That's how do you and I feel about the economy. Whereas hard data, these are measurements. These are widgets. These were how many cars are sold, how many houses are sold. These are hard data prints that take out any sort of emotion. And what's really interesting is if you look at the last year and a half, consistently, the hard data would tell you we are not in a recession and we are not about to go into one. Whereas the soft data consistently told you that US citizens felt like a recession was around the corner. Normally, sentiment is a pretty good indicator, but at least so far it hasn't been the case. And we're not certain on what the reasons are, but we've got a view. And I'd say the view is a couple of things. When coming out of COVID, clearly there's different sentiments and feelings, and people were worried and scared. And so, very simply, coming out of COVID could have been a driver of poor sentiment. The political regime in the United States, very polarizing, regardless of what part of the aisle you are on, that could relate to negative sentiment. Geopolitical risk and wars can relate to negative sentiment. But another point on this is survey data. And in the 1970s, the average response rate for the US government when they put out surveys was around 35%. Today, that response rate is 2.5%. And think about it. In the 70s, you got a phone call on your landline at home. You had no internet. You had no phone to go source. Frankly, people had a lot more free time. And so when they got a call from the government, they were willing to give them 10 or 15 minutes and answer their questions. Today, you get a phone call from an unknown number, or even better, you get a phone call from the Department of Labor. Are you taking that call? The answer is more likely than not, at least based on 2.5% response rate. And if you are part of that 2.5%, could you potentially have an axe to grind or a sentiment that you want to get through that is maybe a little bit more egregious than what the average citizen feels? Again, we don't know for certain, but when you ask the question, how could some economists be pointing to a recession and others not? To us, this is a big driver on some of the data why. Now, inflation, why do we believe it's grinding lower? Well, the answer is because it has been, first and foremost. So this big black line, this was the shipping bottlenecks during the pandemic when durable goods skyrocketed because we couldn't get ships around the world. And we know that's come down. The stickier aspects have been especially services in the United States. There has been a demand for travel, services. People have wanted to spend. There has been a pent-up demand. And this has been stickier than what our economists and really most economists have been expecting. That said, if you look at this chart on the right, the Fed's goal of reducing inflation without causing a recession, we believe is on the right path to a soft landing. And so you can see here, and I'll just point out a couple of these, GDP growth coming out of the pandemic was at 5.5% with all the government support, really trying to stoke growth. You look at where it's at today at, call it around 1.6%. Frankly, we think you're going to have GDP more in the range of 2.5% to 3% by the end of the year here. You look at job to workers gap. This was a real concern. We had 6 million more jobs than workers willing to work. Would this lead to sky high inflation as earnings had to really grow? The reality is we were able to see the Fed maneuver to have companies begin to reduce their job boards. But importantly, we saw this without unemployment spiking. Unemployment has remained below 4%, while the job to workers gap is now down to about 2 million. This has brought wage growth or average hourly earnings down to about 4.3% year over year today. And we needed about 3.5%. So we're almost there to get to the Fed's goal of inflation of 2%. So we're not out of the woods. And clearly this year, inflation has proven more stickier than not. But we think the Fed's going to be able to cut once this year. And we believe next year you're going to be able to see more orderly 3 to 4 cuts over the calendar year. Now, last point on the economy, and I'll check in. I mentioned kind of where we're a little bit different than consensus in the Fed. And here you can see that. We have US growth this year coming in at 2.9%. Consensus is at 2.4. Last year, we had growth at 2.5. Consensus was at 0.5. Now, to put last year into context, growth blew through our estimations and came in at 3.4%. So last year, we had significantly higher growth expectations. We were pricing in no recession when consensus odds on a recession were around 70%. This year, consensus odds on a recession are down to 35 or 40%, but we still see growth quite a bit better. And so this is what's directing us. We've been telling clients we would remain overweight domestic equities. We'd remain invested in equities in general because we felt growth would be good enough to support the equity markets this year. You know, we're only halfway through the year, but so far that's played out pretty well. Christina, let me go ahead and stop there on the economic side of things and check in before I get into some of the market scenarios and see if there's any questions for you or the audience.
Yes, there are questions, and I'll ask the questions, and if that's okay with you, Brian, if appropriate, we'll both put a little piece to it.
Yeah.
And then there was a couple of things, if time permits, because there's a big one. I think I'm going to save this one actually for last because I think it's great for both of us to answer. Some of these I think you covered. The questions came in early, which you talked about the risks. So market's doing great. What are the risks? I think Brian did a great job of talking about that from Goldman's view. I would add another one that's important to consider, which wasn't touched upon, but perhaps we could also get Goldman's view on this: the cybersecurity risks. We have a lot of activity from countries around the world that don't particularly like us much right now, are doing attacks on our systems. Some of these attacks have been successful. Oftentimes, when they're successful, not to keep the public too alarmed, they say, oh, it was due to an electrical failure or a water break or a storm or something like that. But there has been an increasing attacks, and more of them have been either successful and or disruptive to our systems. So I do want to bring up cybersecurity because anything that takes our systems down, be it our infrastructure, our water systems, our internet systems, our communication systems, is certainly a risk. Can be damaging to both a company who's affected, but also to us as a nation. So sorry, I was going to throw that one in there because it is a big deal, and there's a lot of activity in this space right now. We got that from our Washington report. Once a week, we get a report. Economists, we get on a call with Washington analysts, and they give us, as economists, kind of the update on things that are going on. This is non-political and non-partisan. So none of the noise out of Washington, just the facts on the ground. And this is an increasing threat, an increasing problem, and it's become successful. So I did want to add the cybersecurity, not to try to keep everybody awake at night, to give you one more freaking thing to worry about, but I did want to add that because we can't put this into any of our modeling, but it's real. The other one, just quickly adding to the thing about sentiment and that soft analysis too, because this is a question that's come up from a lot of clients. Not today specifically, but over time and it's also been reflected in the media, is that why, if the economy is doing so well, do people feel like it's not? Like the number of people that think we're actually in a recession or things are going terribly. Remember, economy is personal. It doesn't matter what the GDP is. It doesn't matter what the unemployment numbers are. It doesn't matter what the spending numbers are, or anything else. How do you feel based on your life situation? And there's a lot of factors that go into how people feel about the economy. For one person, inflation is no big deal. Oh, my wages went up, so yeah, I don't like it, but I can afford it. Somebody else could living on a fixed income. That could be the difference between now they can no longer spend money on the grandkids or travel or do anything like that. So they're feeling inflation is so much worse. In a highly hyper partisan political world, a lot of times people tend to also take that into the political sphere. And so there is an extraordinary amount of effort with the current administration to keep the economy looking really good. Everything from releasing a million additional barrels of oil to keep gas prices low. And this is public, right? I mean, they've said, hey, we want to make gas affordable for the working class people, release the oil. A lot of money being pumped into the system and whatnot, to try to keep the economy looking as good as possible throughout the election. And by the way, I'm not picking on the Biden administration. Every administration in power does this if they're running for election, right? They want things to look good. The magnitude right now is much bigger. So this is also too how some people could feel like, oh, great, I'm benefiting from this, and other people could feel like, oh, it's not real, it's fake, it's temporary. So that plays into sentiment as well. But anyway, sorry to go a little bit onto that, but that question continues to come up, so I just wanted to talk about it a little bit. How people feel about the economy is how their personal economy and the economy of the people they know is doing, more so than government data. Alrighty, so questions here. So we're going to go with this one. What effect, this is Brian for you, what effect will the current high prime rate have on the economy via loan financing and refinancing?
Yeah, great question. And I see the second question is around mortgage rates staying elevated. It looks like so I could probably build these both into an answer as, and I think this builds into a little bit on our fixed income views as well. So I mentioned earlier, short rates are above 5%, long rates, which we call 10-year treasuries, are around 4.5. You've got 30-year mortgage rates, I believe, slightly above 7. I'm not a mortgage banker, but I think that's roughly where they fall. And so, look, this puts a lot of pressure on people. And to Christina's point just a second ago on the economy's personal, if you're a homeowner and you've got a mortgage rate of 2%, you feel pretty damn good. If you're a home buyer, this is a really challenging economy where you're looking at a 7% rate, you're a first home buyer, and you feel like this country is really tough to live in. So absolutely, I think you're spot on, Christina, in that the economy is personal. And, as much as we share these broad strokes at the individual level, what we're paying at the gas pump, what we're paying for groceries, what we're paying for childcare and insurance, everything is up from 18 months ago. So, very much so, I think that was an important point to bring up. Look, how does higher rates affect this backdrop? Well, like one example is you think about Silicon Valley, you've got a lot of startups here. Well, for the last 15 years, the focus for startups was grow, 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 grow at any cost because the cost was cheap. Debt was really, really cheap to leverage up a business. And so that was a focus. Today, it is profits and cash flows first, growth second. You better have a sound management team. And if you only had a business plan to get through rates elevated for 12 months, you're in a world of pain right here as we're going through year number 2 with rates elevated. So I think there's clearly, you're going to see businesses fail. You're going to see other businesses really shine. We do think fundamentals are back on stocks. And so, the idea of low price passive ETFs ruling the day forever, look, there's a place in every portfolio for low cost beta exposure. But if you think about the world we were in from 2000 up until 18 months ago, we were in a zero interest rate world where cheap exposure to a market was going to get you exposure to asset growth. Because in a world where the Fed's keeping rates at zero, quantitative easing is stoking economic growth, what that allows for is assets to also grow in price and grow in value. Well, today for us, like having a good stock picker that is looking at management teams, looking at cash flows, looking at profits, looking at forward guidance, all of this stuff matters a lot more than it does in a zero interest rate world. So yeah, the short answer is you're probably going to see things break in this economy if rates remain more elevated, certainly at the company level. I think another area you want to continue to watch is commercial real estate. Commercial real estate is under pressure, and about 80% of loans to commercial real estate come from small regional banks. Now, we saw Silicon Valley Bank and First Republic Bank fail last year, and interest rates are still elevated 12 months later. This was literally last May that both of those banks failed. So frankly, we probably will see more regional banks fail as we move forward the rest of this year as rates remain elevated and commercial real estate falls under more pressure. So I think be prepared for that. Be prepared for those headlines. But we don't think the U.S. economy is going to get drawn into a recession because of those commercial bank pressures. It's going to put pressure on regional banks. But I think, one question we ask ourselves is we've got about 3,500 regional banks in this country. Intuitively, do we need 3,500 regional banks? Or do you need less banks with better scalability and better pricing for retail investors? You probably can see a consolidation in the banking industry in the US without needing a deep drawn down recession. So a lot of moving parts there, but the answer is, yeah, when you see rates this elevated for a period of time, we would expect some things to break in the system. But I think importantly, we don't see any asset bubbles. And if you look at the last 30 years, when we've seen a 30 or 40% pullback in this market, it hasn't been driven by a weak consumer and a light retail recession. It's been driven by an asset bubble. The tech bubble in 2000, the savings and loan bubble in the late 90s. These were real the '08, obviously, housing crisis. These were asset bubbles that created a huge drawdown. And look, there could always be something that we're not seeing. But I can tell you from Goldman's research perspective right now, we don't see those asset bubbles in the system. So I hope that's helpful on the answer.
No, it's great. You actually answered 3 questions in that. So good job, Brian.
All right.
I would throw one more thing as well, is that Brian was talking a lot about the effects of the commercial real estate market on the regional banks. I'm also going to touch upon, it is also a regional issue in many ways. Some commercial real estate markets in some parts of the country are doing quite well. They aren't experiencing this. So it's certain areas of the commercial real estate market that have higher risk. It's not the commercial real estate market as in total. Again, there's some areas that are growing rapidly. They have very low vacancy rates. They've expanded well, good government policies. People want to live there, move there, et cetera. And there are other areas where businesses are leaving or are downsizing, either because the area isn't perceived as safe for their employees, and or because they have more of a remote workforce and people are working less in the office, they need less space. So there's a lot of reasons for that, and it's very regional as well. So of course, keeping a really close eye on that, what those impacts may be. But that will kind of tie to the other part of this question was, and I think Brian, you answered this really well, which is a collapse of the commercial real estate market going to lead to a collapse of real estate and or 2008 scenario? I think Brian made it clear that's not expected to be the case right now because it is very isolated. The other thing, unlike the last crisis, is the Fed is well aware of the problem. They brought it up a number of times. It's not a surprise. They know where it is. They know where the issues are. They've been closely monitoring banks and putting more controls on banks. They see it. So they're on it. It would not be as much of a surprise as the last time around was. Anything you want to add to that, Brian?
Maybe just one anecdotal ad that I found has been helpful for some is like just, looking at, I live in San Francisco and I had our head of municipals out last year and he runs $150 billion for municipal investments, which is investing in municipalities across the country. So he's got a really good perspective on, what's happening with retail and office and what are the implications. And obviously, San Francisco is in the headlines for all the wrong reasons about companies leaving and businesses being sold for 10 cents on the dollar and whatnot. And I thought his perspective was interesting. And again, this was last September. I know it hasn't shifted. And he's like, look, Brian, like I totally understand the headline concern that you're bringing to me from your investors, which is, hey, is San Francisco in a world of trouble as it relates to office and retail, given all that's going on, was basically what I posed to him. And his answer was, you know what? All of office and retail in San Francisco combined is only about 12% of the overall revenue for the city, tax revenue. And so you think about that, even at a 50% haircut on all of office and a 50% haircut on all of retail, it would affect the city of San Francisco to the tune of about 6% of its revenues. There's just a lot of revenue streams across cities. What he said he would really more focus on as a threat would be population changes. And so he did see during the pandemic that population growth in San Francisco fell by about 5%. But by September of last year, it had already started to pick back up again. And so just one anecdotal thought is like when you hear office and retail and, oh my God, how are these cities going to do it? There's a lot of different revenue streams behind the curtain that should make cities much more resilient to some of these pressures that you might otherwise think.
It's a good perspective and good reminder of what is taken into account, and also depending on how you are investing. As a municipal investor owning, say, San Francisco municipal securities, the concerns of a decline in office space rental, retail rental, people leaving, et cetera, would be less of a concern to you because, as you mentioned, it's a very small amount of the revenues of the city. However, if you were a office building holder, right, and you don't have people coming back in, what do you do and how do you do it? You see, if you were the lender on that building, the same thing, right? So the risks are not city specific; it's types of investments and how those are being funded. So, thank you for sharing that perspective of from there. Okay, I know you want to be able to cover the economy, so I'm sorry, the election and the economy, everybody's favorite topic right now. I say favorite because people are in all sorts of different states when it comes to this election, and I don't know a single person who's happy and excited about it. So it's regardless of the political leanings. It's, but that being said, before we get to the election portion, government debt is skyrocketing. When will the problems emerge?
Yeah, it's a
And
great.
before you answer that, I'm going to screen share just to make everybody have
Sure.
fun. Sorry, just a second, guys.
No, no, go ahead.
So let me just move this over. Um, so this is from the Department of the Treasury. If I can be able to do this. This is so everyone who is watching, this is from the Department of the Treasury. So this is not from any news media site or anything like that. So there you go. Everybody see this? You want to see it? This is fiscal data from treasury.gov. This is how much the US government has spent this year. It may not sound like much that it's up 6%, but remember, we're backing this up against previous years of COVID related extreme measure spending. So I brought this up because this is the second biggest question that I am getting from clients right now is concerns about the government spending levels. Is there no end in sight? When does this really become a problem? And how can we solve for it? So, Brian, I know you're running for president, right? So you have all the answers to this very vexing problem or concern, but maybe share Goldman's view on this. Is this a concern yet? How may it be a concern in the future? And what, if any, solutions are there to this?
Sure. No, like it's an important question to ask. What I've shared the previous 10 years for the most part, Christine, and you kind of heard my answer to this is, when you think about a corporation doesn't get into trouble because of their debt. They get into trouble when they can't pay their debt. And the same goes for any government. As long as we can step to the market globally and say, will you buy our treasuries? Our debt pile doesn't matter at all. If we have a never-ending buyer of our paper, our debt issues aren't a problem. But the day we have buyers stepping away from the window, overnight, our debt issue will become the biggest issue in this country. And, right now, we're still seeing really good demand for the treasury issues, even year to date. You're seeing good bid. And look, our treasury system is unique. It's the world's backstop. It's the world's reserve currency. And the US has weaponized that to the benefit of the economy over the last 20 or 30 years. That said, this is becoming more of a concern for our research group, really call it over the last 12 months. And the biggest driver of why this is becoming more of a concern isn't just the big increase in spending around COVID and post-COVID. It's much more so about interest expenditures. Interest expenditures as it relates to our government debt is now rivaling what we spend on defense spending as a whole, and will surpass defense spending in the next couple of years. And if we don't start to curtail the overall debt and the overall interest payments, what that's going to mean is all the money we collect in taxes and send to the government isn't going to go to support infrastructure and policies that benefit our individuals in this country. It's going to go towards simply paying down interest. And that isn't in the best benefit of anybody in the country. And so the reality is, and the problem is right now, and let me see if this is in this deck really quick in the election slide. Not,
and if it is, you can
change these decks on me all the time. But the point, I guess, is it's not in here. For both Republicans and Democrats, our debt levels are not a top 3 to top 5 concern. Right now, you have different concerns on both sides of the aisle, but a lot of it is around things like immigration, things like the economy, things like inflation. And so to get Washington and the senators and whatnot to really face this is hard, because the reality is, if you want to fix entitlements, this is either going to mean less Social Security for a lot of their voters, or it's going to be more in taxes for their younger voters. And for people that are looking to stay in Washington, that's not really good policy on either side of the aisle. And so our politicians are not going to face this until us as citizens force them to face it. And so it's becoming a bigger and bigger issue. We're getting concerned about the interest payments. But is this like a concern in our view in the market for this year or next year? No. You still got a tremendous amount of demand for treasuries. We don't see that changing in, call it, the next 2 to 5 years. But look, I mean, with some of the global powers fighting Western interests, You're seeing a pullback from countries like China and buying our US treasuries. Can China get more countries to begin to pull back that puts more pressure on the demand for our treasuries over time? Could you see some sort of digital currency that begins to, if that's backed by governments, that could rival a physical dollar? Like, all of these things are a little bit up in the air, but to answer your question, it's the interest payments that really is starting to worry us as a total percentage of government debt. But it's not something that's going to implicate, in our view, the markets in the near term. But, Christina, 5 years ago, we were saying this is at least 10 to 15 years out. Now we're saying, hey, could this be 5 years out? We're not so sure. So it's absolutely one of the primary risks to be watching, but not an imminent threat to the markets in our view.
Okay, so we just need politicians that'll tell us we have to pay more in taxes and get less stuff. Not holding my breath for that one.
Yeah, we either need, the voters need to put the pressure on the election.
Oh, go ahead. Sorry.
Oh, no, go ahead. Go right ahead. Sorry.
I was going to say, perfect segue. Take it away.
All right.
The elections and Goldman's view on the economy.
You got it. So here, real quick, I'll touch on market views and kind of what do you do. So I mentioned we're above our year-end forecast. So here is the range of outcomes our U.S. equity strategist put out about 2 or 3 weeks ago. So 5,200, if you're looking at the chart, is our baseline forecast, which we're basically at right now. But look, these are always a moving target. And to say like we've got conviction, it's 5,200, that's where we coalesce around a view, but there's always a range of outcomes here. And so what you can see is there's a range of outcomes higher at 5,800 to 6,000. And that would happen one of two ways. One way would be the Mag 7 continues to crush it and can drag the rest of the market with it higher. And look, NVIDIA blew through earnings again this week. So like, it's not our base scenario, but to say it couldn't happen, it's possible. I mean, the amount of earnings being generated by these lead companies that are kind of tackling the initial need on AI is real. The more likely scenario for us is what we would call number 2, the catch-up scenario. And this is what I alluded to at the beginning is, can we see inflation move low enough where the Fed is able to start cutting rates later this year and continue cutting rates into next year, where rather than having the Mag 7, for lack of a better term, could we have the Mag 100, the Mag 150, where you get a broader cohort of the U.S. markets that can participate in a U.S. economy that continues to grow? So those are the scenarios of, again, call it, 12 to 15% upside by the end of the year. That's possible. On the downside scenario, in both cases, you're down about 10 to 12%, which, like, you looked at our downside scenario a year ago, it was down 20. So what's changed? Well, what's changed is the Fed now has some bullets. If the Fed needs to cut rates because we have economic deterioration, they're going to be able to do it. A year and a half ago, with rates at 1.5, there was no safety net for the Fed. Today, the Fed has one. And so if we did see a market deterioration at 10 to 12, whether that's through, the consumer rolling over, which isn't our view, but hey, the consumer rolls over, earnings roll over, something along those lines. If we did get that market pullback, we think the Fed starts to step in around 4,500 to protect the left tail. And so that's our equity backdrop. We think it's more sideways, but there's scenarios for upside and there's a scenario for downside, but now you've got a little bit of a limit on the downside in our view. So we remain convicted in equities for these reasons. On the global equity side, we're overweight US, mainly because we think it's the most stable economy with the best innovation in the world. It's just expensive right now. So like things like US small caps, if you believe we're not going into a recession and inflation and interest rates should move lower, that should benefit US small caps. When we look at foreign, you've got IFA at about a 30, IFA's developed international, at about a 30% discount to US. And you've got emerging markets that's even cheaper. Now, something cheap is not a reason by itself to buy anything, because the US markets have dominated the foreign markets for quite a while now. But like we look at developed international, we've got earnings growth at 5 to 6% the rest of the year, pretty similar to US. You're buying in at a 30% discount. And you've got the European Central Bank that's probably going to cut rates and reduce interest rate pressure before the Fed. that might be, you know, a reason to own some foreign. When we look at EM, China's been the big headwind there, and it's about 50% of the EM market if you buy market cap. But China's throwing a lot of policy at their issues. And so you've seen a recovery from the lows in China of about 25% year to date. You know, China's got some real economic structural issues that are going to take a while, years to try to overcome. But, you know, is there a position to own EM in this market? We look at India, we look at Brazil, we look at Mexico. There's some countries, in our view, that have a really interesting path forward. To us, EM, though, is a perfect example. You want to be bottom up. You want to have a manager that you trust picking the right companies versus owning market beta, where you're going to pick up, in our view, a lot of names you probably don't want to own in countries like China. Now, jump in. I know I'm running out of time. Apologies, Christina. Let me jump ahead to politics for a second because I promised I would cover it. Look, I think when we look at elections, it's going to be close. It's going to be very similar to 4 years ago. Right now, you're seeing ex-President Trump leading President Biden by around 2 percentage points nationally, and in swing states by a little bit more. But we are, you know, a mile away from this election, right? Like November is a far ways off. A lot can happen in between. You know, and you can see right here, this is what I was looking for earlier. When you look at key issues that voters are concerned about, it's the economy, followed by immigration, followed by democracy. Now, this is taken in a little bit of theory, so bear with me. If you take the Democrats in the path to 270 electoral votes to win the presidency, Democrats have a solid 184. They've got 42 that would lean Democrat in light blue. And then in gray, and again, this is just an exercise for fun, if you were to give the Democrats Michigan, Nevada, and Pennsylvania, that would take the Democrats to 266, and they will need one of Arizona, Georgia, or Wisconsin to win the election. With the Republicans, they're at a solid 172, with 47 that would lean Republican. If you give the Republicans North Carolina, that takes them to 235 electorals. And the Republicans would need to win all 3 of Arizona, Georgia, and Wisconsin to win the election. Said another way, 3 to 6 states are going to decide this election. It'll be the independent voters in those states. You can effectively fill a college football stadium with the voters in this country that will decide this election coming up in 5 to 6 months. It will be quite close. I think what's really important as we think about market implications is look, first off, there are some market implications here. The biggest one being the Trump tax code will expire in 2025. And so if you get a Republican sweep, it's likely you get some version of the Trump tax code to get put back in place. If you get a Democratic sweep, the Trump tax code is going to be wiped out. And if you get gridlock, you're going to get something in between. So our view is if you get either party to sweep, you're probably going to have higher interest rates and you're going to have higher inflation in either scenario. Now, so the biggest implication is going to be around tax code. But look, I think the most important point I can share is what's on this slide. So the average return the year that we have a new president is around 10%. But if you look here, if you get a Democrat, it's 13, Republican, you get 11. But if the controlling party in Senate is a Democrat, you get 11%. If the Republicans control the Senate, you get 16. On the House, it's about equal. But if you look at the right here, here's the punchline. The statistical significance of who wins any of these president, Senate, House, etc., there is no statistical significance with who wins these elections and how the market reacts. And look, if you were to go back to when President Trump got elected, and if you were a Democrat and said, go to cash, you missed a tremendous rally. And the same has gone when the Democrats win. And so try to take your emotions out of investing. Do not allow your political party orientation dictate how you're going to invest. That should not be the primary driver. What should be the primary driver of how you invest is what is your financial plan? What are your long-term goals in your life? And, rely on Sequoia for what is the right investment philosophy for your personal needs. But to us, this is really, really important. Look, it matters who gets elected. Stump for your candidate, stump for your political party, go vote, support your candidates monetarily, try to separate how you invest with your politics, and we think you'll be in a better spot. But with that, Christina, let me go ahead and pass it back to you. Happy to take any final questions, but again, appreciate the time today.
Okay. Thank you very much, Brian. It's always nice to hear you and Goldman's views, as well as an opportunity for you to speak to not only the people, again, live here today, but the 270 whatever that registered. So I think we got a lot of interest in the subject in many ways. Excellent job. Just a couple of housekeeping notes. Sorry, I'm going to answer the last question that came in really fast because I promised to answer all the questions, even if we run a minute or two over. The question was, I missed this one from earlier. Do you expect mortgage interest rates to decrease? And if so, what will be the impact? Or what will the impact on housing prices be? I wanted to separate two things quickly on this one, and I'm by no means a real estate expert. I have a lot of experience investing in it or owning it, but I'm not a real estate agent or a real estate professional. I will say that real estate prices have to do more with the interest in the property in relation to the supply. Mortgage interest rates certainly have an impact on that, but less than you may think. In the markets I'm most familiar with, and I believe it to be true across the country, we have a supply and demand imbalance. There's much more demand for property than there is a supply of property in most markets. And that will likely keep prices higher, even if some of the prices soften from the amazing run up that real estate has taken over the recent years. If a lot more supply comes onto the market, certainly prices will soften. If interest rates are cut, certainly that can help support prices. However, the biggest thing that you have is a lack of supply in relation to the demand, and the fact there hasn't been enough building to meet the demand overall. In some states like California, things like Prop 13 and other types of policy has kept people in their homes longer than they historically may have ordinarily stayed in. How many of us know someone, or maybe you are that someone yourself, that's like, I'd love to move to a smaller house, move closer to the grandkids, move for whatever reason, but I got this great property tax. Now, California did pass Prop 19, which allows people over 55 to transfer their property tax basis if they were to buy another home in another location, but that doesn't help with the cost of housing and the tax implications of selling your home. So a conversation perhaps I'll carry forward in more detail in an upcoming webinar to talk a little bit more about this. But I just wanted to touch upon that if interest rates, if the Fed does cut, there are no economists that are really I'm seeing that are saying they're going to take us anywhere close to where we were during the pandemic period. They may cut a bit what they need to stimulate the economy, but I don't think we're going back to where we were. Just quickly in a couple sentences, I don't know, Brian, you want to add to that?
No, I think that's right. It really is a supply demand impact where we don't have enough homes for people to buy. And so that's where home prices probably will be supportive regardless if rates fall or not in the near term. But we don't expect long rates to fall much. We've got 10-year treasuries ending the year about where they sit right now, maybe a little bit lower. It's going to take a while for longer rates to fall. So you're probably going to expect mortgage rates to remain more elevated than not. To your point, Christina, the Fed isn't looking to materially move rates lower. More so, can they modestly move them lower over the next 12 months? We've got the 10-year at the end of next year at around 3.5%. So that gives you a little bit of perspective on where we think rates fall.
Okay, I do. All right, so I will wrap this up to be fair with everyone's time. Keep in mind what Brian said earlier. If anyone listening to this call today has an interest in any of the slides, there actually are some more that he didn't have a chance to go over today. Just please reach out to me and let me know. Happy to send them to you. And also too, one thing, most important thing of all of us to understand is that each and every one of your economies and each and every one of your portfolios and your financial plans are yours. They're highly customized and individualized for your specific situation. So while this is great to talk about the economy and kind of the broad levels of this, if you have questions, concerns, ideas, thoughts, or anything, we are happy to talk with you. We're happy to. So please do not hesitate to reach out. Happy to answer those questions. Happy to talk about your specific situation. This is, again, I can't stress enough, there's a purpose to all of this. beyond the broader economy and beyond the geopolitical and the political. The purpose is what is the highest probability of you reaching your goals successfully? And that is the work that we do. So thank you all very much for listening this afternoon. Thank you, Brian, so much for taking time to be able to do this webinar. It is greatly, greatly appreciated. And thank you everyone who took time out of your day, whether it's live now or later in the future to watch the recording, to listen to this. And any other ideas that you would like to hear about or any topics of interest, reach out and let me know. And more to come as the year progresses. Thank you all for listening.